Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Monick Sawyer.
Welcome to the Syndication series, where you're going to learn all about what syndication is and how you can utilize it to build cash flow and grow your wealth. It's a really exciting strategy, and I'm looking forward to sharing all of our guests with you. So now let's get to the show. Hello, ladies. Welcome to this episode of Real Estate Investing for Women. And we are going to do things a little bit differently today. So I am bringing back to the show Monick Halm. And we've had Monick on the show before. And well, she's actually doing a presentation. And I will just interrupt with some questions. The other thing is she is actually doing a slideshow. So if you're a visual person and you want to see the slides, you can go to YouTube and look up Monick Sawyer, Moneeka Sawyer, or Real Estate Investing for Women, and then you'll be able to find this video. You can also go to Roku with Real Estate Investing for Women with the number 4. So you can look us up there. All right, I'll stop talking. I'm going to turn it over to Monick. Hello, Monick. Welcome back to the show.
Thanks for having me back to talk about one of my favorite things.
Yay!
This is how I love to invest in real estate. I found it a little bit by accident, which I'll talk about, but I'm going to share my slides now. So for all of those, I'll try to be as descriptive as I can to those of you who are just listening on the radio. And for those of you who want to see the visuals, again, go to YouTube or Roku to check it out. So I'm going to be talking about real estate syndication, how to passively invest in real estate, earn double-digit returns, and not have to deal with the 3 T's. The 3 T's are tenants, toilets, and termites. So this is a way of passively investing in real estate that is pretty high return and lower risk. Nothing is risk-free. I want to start by saying that it's not like, can't guarantee you returns. If anybody says that they will guarantee you a return, then run in the opposite direction. Nobody will guarantee it. But this is a relatively lower risk investment, and I will share why. So before we get going, I'm just going to briefly introduce myself and why I talk about this. So I am a real estate investor, and I'm a syndicator, which basically is syndications, crowdfunding real estate. I bring groups of investors together to purchase real estate. And I've been in real estate for 15 years. I have a little over 1,300 rental doors in 7 states. I've raised over $35 million with my partners since 2016 for real estate portfolio worth over $220 million. I've written the book, The Real Estate Investor Guy's Handbook, and Wealth for Women, Conversations with the Team That Creates the Dream. And my newest book is Investing in Real Estate from $1 to $1 million, which is available as a digital download for free on my website, reigoddesses.com. I also have a podcast, Real Estate Investor Goddesses Podcast, and I'm a real estate investment mentor, educator, and coach. And that's me in a nutshell, and a little bit of my background for why I'm talking about this. So first, let me just briefly describe what is real estate syndication. In the simplest terms, a syndication is a structure or relationship between multiple investors who pool money together to fund a project, real estate or otherwise. And investing in a real estate syndication is essentially investing in a real estate enterprise as a passive investor alongside multiple other investors. In English, maybe that is basically, we crowdfund, we bring together a group of investors that will passively invest. And we'll talk a little bit more about what all of those different roles are in a second. But first, is syndication something for you? Maybe you can relate. If your real estate vision is big, but you're not sure if your bank account balance is big enough to fund it, then you might be interested in syndication. Or if you have some money set aside, but you'd like to be able to leverage it, spread the risk, you don't want all your eggs in one basket, then syndication might be a good fit for you. If your life is really full and you're not sure if you will have the time or other resources necessary to successfully invest, then syndication could be a fit for you. And if you fit any of those things, and I totally understand, because that's where I was. And I want to share my story, which you might relate to. So I grew up like Monique. I'm a first generation American. My parents are from Haiti, and I was always taught. I have super supportive parents who are always like, you can be anything you want, in parentheses, as long as you're a doctor, lawyer, professor, engineer. Like
I
that was
can't
it.
relate to that at all. Nope.
I'm sure you can't. I'm sure that's not anything that you've ever heard. Well, I wasn't as into the maths and sciences, so I went to law school. I ended up at Columbia Law, and I was partnership track. On my slide, I have a picture of me walking. I'm in Japan, walking to our my firm there. I was working for big international law firms, partnership track, 6-figure income. I checked all the happy immigrant parent boxes. Like I'd done everything right, and but I was miserable. I was so miserable, and I was so miserable that at one point I found myself in the emergency room. I remember the Tuesday morning. And when the doctor told me that my appendix had ruptured and I'd have to spend several days in the hospital, I ended up spending 9 days in the hospital. And then he said I'd have at least 30 days afterwards to recover. My first thought when he said that was, oh, thank God I don't have to go to work for at least 30 days. I just had this incredible sense of relief. And then I'm looking at your face and you're just like, oh my gosh, that's horrible. And that was my next thought, was like, oh my gosh, I can't believe it didn't hit me until that second how unhappy and miserable I was. And I just taken it for granted that I was meant to be that unhappy, but it took that moment and that to give me clarity about that is not normal. That is not good. That is not okay. But I had done exactly what I was told. I had followed the path exactly, and I was that miserable and that unhappy, and so I knew I had to find a different way, because I knew that they don't know what causes appendicitis, but I was sure it was stress from my job, and that job was literally killing me, and I had to find a different path, and that was not an easy thing to do, because like I did the path that I was told would lead to success, and I did the path that I think my parents believed would lead to success. So they didn't know better. They taught me what they knew, and I fell into real estate completely by accident. So the only thing they'd ever taught me was to buy my own home, and that was what they knew about real estate. Monica, you were a lawyer. You were lucky because your parents knew about real estate investing, so you were kind of born into it. But I was not. My parents just knew: get a job, trade your time for money. That's it, and then buy a house that you live in.
But I
gives you no money.
Yeah. But it gets you started. At least they said buy a house. I don't know how many people whose parents didn't even know that much, right?
That's true.
So,
at least I had that.
At least you had that. I mean, you had so much. It sounds like your parents really adored you and really wanted the best for you.
They did. They're great parents. I love my parents. And they definitely did the best they knew to do. They taught me the best they knew to, so they were very supportive.
And I actually wanted to highlight something that you said, Monique, which I just think is so valuable. And ladies, this is something to think about. We're talking about real estate, but one of the things that Monique found in that hospital, and I know I've been here too, is how do we define success, right? She did everything right. I did the same thing. I did everything right. Our parents told us what success was going to look like and how we were going to get there, because that's the best that they could do. That's what they knew. But the way that they define success is different than how we define success, right? And so we have had to create a new life based on our vision of success. And that's a really, really important key for you ladies to keep in mind. How are you defining success, right? I love what Monique was talking about this might be for you if. So if that is you, how are you defining success and what are the next steps, right? So I just wanted to highlight that success looks different for everybody, right?
Yeah. Well, for me, success, now is like, it's doing what you love, like being able to do what you love with who you love when you want to do it, right? Like that for me, that is success. And, you know, and after having spent lots of time doing things that were like killing my soul, like that was what it felt like being a lawyer. It's like, it felt like it was killing my soul. It literally is killing my body too. But, you know, after having spent that much time being miserable, having now the freedom to, you know, to do work that I love and I'm passionate about, that I have, but I have passive income streams, so I don't have to work if I don't want to, and I can, you know, and I get to make a difference and spend time and vacation and do all of those things that I want to do when we're allowed to leave the country, when we're allowed to leave our homes. And I have freedom. So, and that's success. But I didn't start there, and I got there by a series of happy accidents. So I was sharing that when I went to go buy my home. This was in 2005, towards the top of the last bubble. I live in Los Angeles, very expensive market. You understand being in expensive markets. So those of you out there in the, you know, much cheaper markets really like can't conceive of the prices that we have to pay. So even back in 2005, a starter home, you know, in a semi-decent neighborhood was upwards of $600,000-$700,000. And I had a six-figure income, a low six-figure income. So that was really challenging for me. But a friend of mine who was in a similar boat suggested that we buy a duplex together. He'd live on one side, I'd live on the other side. The original plan was to get this like a property with two equal sides. But we ended up finding this old Craftsman that had a larger downstairs unit, a 2-bedroom unit upstairs. It had a converted garage in the back that was a 1-bedroom. And we ended up taking a bedroom in the bigger unit, renting out our upstairs, renting out our back house, even renting out our basement. And I started to house hack before I knew that was a thing. And I went, this is awesome. These people are paying our mortgage and I got tax benefits. This is great. And then I met my husband. He had a duplex and we got a single family rental together. And then after the market crash, we started to flip houses. When houses were on sale. Houses are about to be on sale again, ladies, so get ready. So it's going to be a very good time to be a real estate investor very, very soon. But then by 2015, houses were not so on sale. It was getting really frustrating. And flipping houses it's a short-term job. I mean, it's like a short-term contract. You do it, you fix it up, you sell it, hopefully at a profit, and then you have to start over. And I wanted something more passive. So I started to look for a fourplex, which at the time was the largest thing I could think of. And in LA, you cannot find anything that cash flows. It was pretty much impossible because it was going to cost a fortune and there was no money coming back from that. And so I ended up being introduced to this man that would become my mentor, Robert Helms, who is the host of the Real Estate Guys radio podcast. He's done hundreds of millions, maybe even over $1 billion worth of transactions at this point. And we had a mutual friend. When I was telling our mutual friend Kyle how frustrated I was, he said, "Oh, you know what? My friend Robert Helms is going to be in LA tomorrow. You should come and meet him." And so I met him, and he's the one that changed everything. This 10-minute conversation, and why I'm here talking to you right now. This is exciting. But so he super nice man. He asked me, what I was doing. I told him about the flipping and how that was getting challenging and looking for the fourplex in LA that would not cash flow. And he said, I always say, he goes, LA is a tough market. I always say, live where you want to live, invest where the numbers make sense. You're nodding, Monica. And that makes total sense after you hear it. But until he said that, I always thought you had to invest where you could drive to your property, touch it, self-manage it. It never crossed my mind that I could invest outside of where I lived. So literally that opened up the world to me. And the other thing he said was, and you can buy that fourplex by yourself, but you're limited to your own capital and credit. He said, alternatively, you could bring a group of investors together and you can get 100 or 200 units. And he started telling me about the benefits of that. And my brain, I think, exploded right there. I was like,
She's
what?
all 10 minutes and I'm floored.
I was like on the floor, like, what? That's a thing? You can do that? And I went, that? I wanted to, like, everything in my body, just like, I got chills, like, oh my gosh, that, I want to do that. And so that was that was very exciting to me to find out. And I went home and told my husband that night. It's like, oh my gosh, there's this thing called syndication. You can bring groups of investors together. I was like, we need to learn how to do that. And the real estate guys, Robert Helms and his partner Russ Gray, were teaching a seminar on it in January of that next year. So that was January 2016. So we went to that seminar, signed up in there with their program, and then we met Brad Sumrock, who he was our apartment syndication mentor. We signed up with him. We went to like tons of different events throughout that year and since to learn how to do that. I've probably invested over $60,000 just that year in education, but it paid off. We ended up syndicating and getting into a 109 unit mobile home park in North Carolina. We did 318 units in Dallas, 514 units in Atlanta, and then 51 unit townhome community, and then a 77 unit apartment community in Albuquerque, all in that first year. So over 1,000 units in that first year through syndication, through bringing investors together. So two of those deals we were passive,
I was
and
going to
then
say,
three
Monique,
we did it.
you take things slowly, don't you?
Yeah, I took
well,
my
wait
time.
a minute. Sorry to interrupt. I just had to say that. But you said only two of those were passive?
Yeah. And then so the mobile home park and the two in Albuquerque we syndicated. We were actively investing, but we still passively invest in things as well as actively invest, and there are benefits to both, which I'll talk about in a minute. But that's, and since we've sold, I think other than the mobile home park, all of those things have been sold, and we have new ones. Now we have a little over 1,300 in different asset classes, different states. It's allowed us to diversify. It's allowed us to scale and grow and quantum leap in ways that I had never imagined possible. And so that's all. I'm very passionate about it. And I also just briefly, I have a picture of a slide of, you see this me. It's hard to see, but I'm actually wearing a tiara, but I'm surrounded by a bunch of men, which was like the mastermind that I was in, and this is being surrounded by so many men in that field. And we were, first we had investors, like 90% of our investors were men. I had been working with women, but it came as this divine download to bring women into this game and especially invite them into syndication. So I created real estate investor goddesses and to just bring women into this game. And my mission of helping 1 million women create financial freedom through real estate investing, that came as this divine download. Not the how of it. I'm still figuring out the how. I'm still trying to figure that out. I'm a ways from that, but the what of it has come, and so it's been really great, and the word's been going out, and so I'm very passionate about getting, like you, Monica, getting more women into this wealth building lucrative game. So, but I wanted, and one of the ways I think is so great for women is with syndication, because a lot of us are busy, right? We have jobs where now we have to homeschool, and we have, there's so much, with parents to take care of and kids to take care of, and all of this stuff. And this is a way of being able to get into real estate that is passive, that doesn't take time past vetting. Or, so, some of you might be interested in being on the other side of it too, where you get to bring groups of investors together, and you can benefit a lot by being on, the active side, which is the side I mostly play on. But either way, there are a lot of benefits. So why would you want to do that? First, it allows you to buy more than what you could afford by yourself. As a passive investor, you get to leverage OPM, other people's money, because not just your money, it's the money of all the other investors, and often a bank too. So we usually get financing as well as all of these investors that come in. So you're really able to leverage OPM to get something that's generally much bigger than what you could afford by yourself. And you also get to leverage OPT, other people's time. Because somebody else is going off and finding the deal and putting it together and bringing all the investors together, and you just have to vet the deal and then send in your funds and your money and wait for it to come back with friends. It allows you to spread the risk, because again, it's not all on you, so the risk is spread. And also, as a passive investor, you have very, very little to no liability. You spread the wealth. As a syndicator, I get to create an opportunity for many people to benefit. And as a passive investor, you get all the benefits of being a real estate investor, like the tax benefits and otherwise without the work. So with a real estate syndication, there are a lot of benefits. It gives you the benefits of passive cash flow. Again, you get a share of the monthly cash flow. You get a share of equity that's, at the end when we sell, but you get passive cash flow. You get federal tax benefits. So a lot of people don't realize that that you sort of have the assumption that the more you make, the more you pay in taxes. That's kind of what we're told. Right? Higher income, more taxes. Except when it comes to real estate investing, because of the way it's structured and within the tax code, you often end up paying less. So a lot of people will get into real estate, especially when they have businesses and they're very successful. A good savvy CPA will say you should start investing in real estate because you're paying too much in taxes. And even though you're making money with your real estate, because of the way real estate is, it looks like a loss for tax purposes, you'll pay less. I have a very good friend who's a successful businessman. He found himself one year owing $500,000 to the IRS. And he had always assumed the more you make, the more you pay in taxes. And he was very successful, so multi-million dollar businesses. And he found out about this, about real estate. He bought an apartment building in Memphis. And it was an apartment building that was making money. I think it was making six figures a year of income. But it brought his tax bill from $500,000 to zero. From $500,000 to zero. So he was making more money. And not only did he make the money, but he saved on the money that did not have to go to Uncle Sam. So it's not just what you make, it's what you get to keep. But real estate investing, even as passive investors, you get to keep more.
I actually want to just chime in there with one quick thing, Monique, is that, I've said on this show so many times that no matter how someone became rich, the rich always invest in real estate, and that's where they make the majority of their money, right? So they make a huge amount of money in real estate. They also save a lot of money in real estate, which they can then grow again in other ways, whether it's in their business or in real estate. So Monique just gave you a really cool breakdown of why that is, why the rich invest in real estate. And what's so cool about real estate is that you don't have to be rich, right? This is available to everybody, especially here in the United States. This is the most amazing country that way, because this is not true elsewhere. The government actually supports everybody from a single mom all the way to the richest person on the planet in investing in real estate. So we're supported to do that. It helps us to grow true wealth, and it helps to lower our tax bill. So there's so many good reasons to invest in real estate.
Yep. The government wants you to invest in real estate. That's why they give these incentives in the tax code. It's to get more people to invest in real estate. I heard that there's a book called The Color of Law, but basically it started in the 1940s after World War II. They thought that if people owned real estate, they would not be capitalists. They would be capitalists, they would not be communists. So it was a way of helping stop communism. Whatever the reason, it's a good thing if you're a real estate investor. It helps you out. And exactly, people who have a lot of money, they shift from being about income to being about wealth preservation, and real estate really helps you preserve wealth, not just because it appreciates and some of these other benefits, but because of the enormous tax benefits that help you not just save money off of your real estate income, but it helps you pay less on all of your income, or like more of your income, not all of this. I'm not a CPA, but it really helps you.
Yes, check in with your CPA on this.
Check in with your CPA. It doesn't really go off your W-2 income, but anyway, so it's I'm not going to go into all of that, but it is it's very beneficial tax-wise. So there's also this leverage that I was talking about before. You can leverage OPM, other people's money. You can leverage other people's time. And when you're able to when you're in a syndication, we're able to do much bigger properties, and there are economies of scale and leverage in that way. Retirement savings. So, we started out, this came up because people are saying, I have this money in my retirement account and I'd like to be able to find investments that make sense, that are lucrative, that are relatively safe. And with a self-directed retirement account, so not the account that your work's going to put you in normally, which just gives you a very limited menu of things that you can invest in. It's like some mutual funds, some bonds, and it's like this little menu. But if you can self-direct your money, then you can put it into real estate and generally get better returns. And also with appreciation, with real estate, you get appreciation. Over time, properties tend to go up in value, but you can also force appreciation by doing targeted rehabs, which is what we do with syndications. So we have a business plan. When we get we buy a property, we have a plan to add value to that property and appreciate the value. So it's worth more. Generally, after a certain amount of years, we'll sell and be able to recapture that. But even on paper, as the value of the building grows, so does your net worth. And it allows you to leave a legacy, which is, I know for many of us, one of the main reasons why we want to do this. It's real estate, since basically time immemorial, has been the main way that people have built, preserved, and passed down wealth. And it still remains the same way. So that's one of the best ways to build and leave a legacy. And it's a feel-good business, right? That's very win-win. I only invest in ways in which I can leave a property in a community better than we found it. And so in our syndications, that's really a focus, and it feels good, and it's like it's a wealth building opportunity for everyone touched by our deals. And so that's why I love it. Okay, so those are the benefits. And unfortunately, it's like you're listening, but think about what are the benefits for you? What's your why behind real estate and investing in syndication? Because depending on what are the whys that are more important to you, there are certain deals that will give you more of those benefits or less. So really tap into your why behind them. Okay. So what types of properties can be syndicated? Basically anything can be syndicated. You can syndicate debt. So sometimes you'll just have it'll be a fixed return, and it's debt. It's a loan basically that we're syndicating. You can syndicate equity, ownership stake in the property. You can syndicate raw land. You can syndicate single-family residential properties. I put an asterisk near this on the slide because usually you're not going to syndicate. Syndication is generally for larger commercial projects. There's a lot of expensive legal work that has to be done. I'll talk a little bit more in a minute about the legal ramifications of this. It's not something that I would recommend you just go out and just ask a bunch of people to give you money for something, for a deal. There's governed under the Securities and Exchange Commission, and it can be pricey to put one of these together. So the numbers have to be justified. The deal has to generally be large enough to justify the legal costs of putting together a syndication. So you won't find a single family residential property syndicated usually unless it's going to be used for something like a residential assisted living facility, a facility that, where people are paying upwards of $4,000 a bed to be there, and it's a very high cash flowing business, then you might you'd see those get syndicated. But otherwise, if it's just like a house to flip, you normally won't see that. But they could be if somebody wanted to do that. Multifamily apartment complexes, that's very common. Office space, retail, industrial, you name it, it can be syndicated. And who's involved in the syndication? So you're going to hear the term syndicator, sponsor, active investor, general partner. Those are all used interchangeably, and that is to describe the individual or company or team that's finding, acquiring, and managing the real estate. So generally, they're going to have a history of real estate experience. They should have a history of real estate. If they don't, do not do this with them. But they'll have a history of real estate experience and the ability to underwrite and do due diligence on the property. So they're the active investors, are the ones doing the work. There's a joint venture equity partners. So sometimes that's my role in deals where we have a group of investors and we're not on the operations side, but are bringing in funds for the investment. So we're connecting our investors to operators. So we're part of the sponsorship team. So with a JV or equity partner, it might help with as well financing. They're helping with reporting, communications, tax documentation, that sort of thing. And then last but not least, there's the passive investors, sometimes called limited partners. And those are individuals who will invest in the syndication. They own a percentage of the real estate as a result. If it's an equity deal, or they'll have a percentage, they'll be part of the loan. If it's debt, they get all the benefits of property ownership, not involved with acquiring the property, arranging financing, or doing any of the day-to-day management. They cannot be. So think of it more like, if you're buying stock in Apple, right? So you own a piece of Apple when you have a piece of their stock. And if they do dividends, then you would get your dividends. And then otherwise, you have that ownership stake. But you're not going to call the company and say, hey, I want you to change this feature on the iPhone. Great. I mean, you could. Just like our passive investors they can call us and tell us what they'd like to change. But in terms of like who's managing it, who gets to decide when to sell, what to do, who's the team, then that's on the active investor side. Okay, so I'm going to share an example of a fairly typical example of a 100-unit apartment building. And this is one that we did. I've sort of like rounded out the numbers to make this easier to understand. And this is not a guarantee of results, but this is not atypical for a syndication. This is fairly typical in terms of returns. So this one was a deal that was a $5 million purchase price. Rehab budget was $500,000. So we're buying this apartment building, fixing up the units, getting them nicer so we could raise the rents to market rates, and because it was under market, underperforming this property. So there was a loan. We got a loan 75%, $4.125 million. So the interest rate was 5%. At the time. It's lower now. So we had a down payment of 1.375, closing costs of 200,000, cash reserves of 75,000. Basically, we were raising 1.65 million dollars. So rounded up, 33 investors at 50,000 each. So, and I won't go through all of the various numbers. I'll just highlight the end result for those of you listening. But after the total cash flow, so the whole profit was $51,575 after 5 years. So basically, more or less doubled the money of the investor after 5 years. Part of that was in cash flow, about a little over $23,500 was in cash flow. Sales proceeds were close to $78,000, and then that was the profit. So not bad for something that is passive. And that is not atypical for for these types of syndications. So on the active investor side, that also invests 50,000 in the same deal. So as an active investor, that you get to have, you get a share of the cash flow and the acquisition fee. There's also asset management fee, and you get a share of the equity and cash flow just for putting together the deal. And then there's fees for managing it. So in this case, as an active investor, we also put in 50,000, had the same profit that all the other equity investors did, 51,575. There's a 3% acquisition fee of 49,500, 1.5% asset management fee, 60,257, 15% deal sponsor equity share of 116,700. So the total sponsorship return was $287,032. So on $50,000 and sweat equity. So there's a lot of sweat equity in that, but that's the return. And that return would be, if there was a team doing that all the acquisition fee, asset management, deal sponsor equity, it would be split amongst the team members. But you can, get 3 times or more of the returns by being on the active side and doing the deal. So it can be very profitable either way. So does this sound like something you might like to try? of interest. Yeah.
Exactly.
Yeah. So it's one of the nice things about it, is as a passive investor, you can learn, but you have to vet the deal and then wait for it to come back with friends. So, for those of you who are interested in being on the active side, I have a warning slide here. Do not try to do a syndication without a qualified securities attorney. You could win yourself a very hefty penalty and an orange jumpsuit and some jail time. So you want free housing, but not that way. So they really do make sure you know what you were doing when you take on other people's money. And you can't usually advertise an opportunity there. It's very regulated in terms of who can invest with you and how. And generally, it's going to be people with whom you have a substantial pre-existing relationship, and they have to be sophisticated enough to understand the deal. Or you're only dealing with accredited investors. And for those of you who don't know what an accredited investor is, some people think it's like, oh, I'm not accredited. I haven't taken the test. I don't have the certificate. There's no certificate. There's no test. It's you qualify either through your income or through your net worth. So with income, if you have an income as an individual of $200,000 or as a married couple of $300,000 per year, you've had it for at least 2 years with a reasonable expectation that you will in the subsequent year, you are an accredited investor. And if you have a net worth of $1 million or more, not including your primary residence, then you are an accredited investor. And congratulations, you are part of the 8% only of the population who are. So most people do not fall under that, but if you do, you're an accredited investor, and that generally will allow you to take advantage of more of these types of opportunities. So some of them are for accredited investors only. Some are for both, but you do have to have a pre-existing relationship with the person bringing the deal. And if you are trying to syndicate, then you need to understand like when you can take a credit, or are you doing when and how you can take people. But generally, if somebody's like talking about this on Facebook, be wary, unless it's accredited investors only, and they could do that. All right, so yeah, you can't just take anyone's money, even if they really want to invest it with you. I've had certain deals where we had to have that pre-existing relationship, and somebody comes and I've met them after I have already the deal. They're like, I really want to put money into it. It's like, I really wish I could take your money, but I can't. And the next one, like, we're going to get to know each other now. And next time, you could, if you feel like it, but I can't now. Okay, so if you want to find out more about these passive investing strategies, we have an investor club at Real Estate Investor Goddesses. I created this club because I wanted to get more women in knowing about these types of opportunities. So the Investor Club doesn't cost anything to be part of it, and you're not obligated to do anything, but it allows us to get into that pre-existing relationship, and you then get access, which otherwise it's hard. A lot of people are like, how do you find out about this? How do you get access? Well, you have to get into a relationship with a syndicator, and that's how, and I deliberately set out to get more women into this game, because when I started, 90% of our investors were men. Now I'm happy to say 90 plus of our investors are women. Yay. And I love being able to get more women into this, because they're really great investments. And I have done better on my passive investments than I ever could have done, like investing in LA or these expensive markets where I was doing all the work. And so they can be really lucrative. And, in terms of let me talk a little bit about risk for a minute, because there is risk, and here's where the biggest risks are. And here's how to mitigate the risk. So these are great. They can be great opportunities, but it's really important that you invest with the right people, and because team is everything with real estate. So there are 3 things to look at in order of importance. First is the team, next is the market, and next is the property and the plan. But it's in that order of importance. Your team is very important. So you want a team that has a good track record. You want a team that's very trustworthy. And a good track record does not necessarily mean they've never lost money. So sometimes, Robert Helms, my mentor, would say he actually would not invest with anyone who had not lost money before. He wanted to invest with somebody who had lost money and stayed in the game. And he wanted to know, like, what happened when it went bad, how did they deal with it, and are they still playing in the game, right? Because things happen. Like 2008 was very bad for a lot of people, and there might be some deals that people bought not quite as right, a year ago, that might not be doing so well right now. And how are they handling it? How are they going to get through it? That tells a lot about somebody. So it's not necessarily that people have they've never had like a miss, though that's not a bad thing. But you want to know that they've been able to handle it. They have a long track record. They know what they're doing, and they're trustworthy, and they're following the rules, and they're doing it right. So the team is really important, and then the market. So where are they investing? And then you start to look at their business plan. So what is the property they're looking at, and some of the assumptions they're making. So some people make some assumptions, like how I like to be to under promise and hopefully over deliver, but not everyone has that. So how are they underwriting? So those are the things you're going to want to just be able to vet, vet the people, look at the deals, make sure it makes sense for you, and then if it does, then you raise your hand, say I'm in, and you invest and wait for your money to come back with friends. So that's how you do it. But when it's a good deal. A lot of these deals, because we tend to buy properties that are already cash flowing, they're already stabilized, they have a plan to increase cash flow, but when things tend to go bad, you may not meet the mark that you wanted to, but it's unlikely to lose your money. So that's why it's a good, I think they're great investments.
Very, very cool. Are most of your projects like 5 years?
5 years is a fairly typical hold plan period.
Mm-hmm.
A lot for the past few years, we were getting out more quickly because of the way the market was going. The price of things, people were paying more and more money for the same amount of income, and it became a very good time to be a seller. So we were selling. I like to be a seller when it's a seller's market and a buyer when it's a buyer's market. So we started to sell because we could hit our returns more quickly. And if you hit your number quickly, right? It's better if I could get somebody, 100% return in 2.5 years versus in 5, right? So we were selling as more quickly when it made sense. Now, looking at where the market is going, it might be closer to our 5-year period, or it might not make sense to sell in 5 years, and we may hold on for a year or two. So generally, as the sponsors, we're going to do what's best for our investors, and we'll sell when it makes the most sense. But if it doesn't make sense to sell, if we're going to sell it, down at a loss, right? Then we hold off, because we're generally we're always cash flowing, and then that 5-year plan might become a 7-year plan, depending on what's happening in the economy. Or sometimes it's a 2 or 3-year plan, or we go in 2 or 3 years, if that makes sense.
Got it. And
Yeah.
is there a particular class that you invest in?
Yeah, so right now, most of our investments are in Class B multifamily, and we're also doing a lot of industrial. In fact, we're doing more industrial right now, as there's a lot of uncertainty in the rental market, because as more and more people are losing jobs and not able to work, that's harder. But industrial is the one asset class that has been least affected by what's going on. And so one of the things that we're doing a lot of are types of deals called sale leasebacks. Basically, it's a company that has a facility. So this year we've done um, we did a frozen pie company, and we did a organic baby food company, and we have a couple others, but they're essential businesses. Their business is doing super well right now in this crazy economy. But they have these facilities that they had built, and they wanted to get equity out of them. It's hard. They couldn't refinance to get the equity they needed, so they're selling it, but then they lease it right back, and as our tenants, with these triple net leases. And triple net leases, for those of you who don't know, what's great about triple net lease is they tend to be very long. So these are 20-year leases that we have with our sellers slash new tenants. And then they pay a triple net lease. Not only do they pay rent, they pay property taxes, they pay insurance, and they pay all of the maintenance. So they basically take care of all of the expenses, with the exception of any debt service. We have loans on the properties, they're not going to pay for that. But all the other expenses they cover. So there are no surprises. And we have built-in rent increases in these in the leases as well, year over year. So you know what the income's going to be, what the expenses are going to be, and then the plan is we sell them to institutional buyers after 3 to 5 years, and very similar returns to multifamily, cash on cash returns in the 8 to 10% range, with cumulative annualized returns in the high teens, low 20s. So we really like them, and they feel a lot more safe and stable. These, especially in this type of climate. So we've been doing these.
How do you find those?
So we have partners that have been doing this for, I don't know, like close to 2 decades, and so they're one of very few people who do this. It's a very, very niche segment of the market, which is great, because I don't like going where a lot of the herds go, right? I try to look away from where the herds go into places that are a little more where it's a little greener, more open pastures, right? And so these companies will contact them, our partners, and so the big part of the due diligence on these is really due diligence on the company, to make sure that it's a company that's going to last a long time. The good thing about these long triple net leases is, you know, you have a tenant in there. It's super easy. There's almost no property management, very little to do. But when you do lose a tenant, if you do lose a tenant, it can take a while, you know, some months, sometimes a year or more to find a replacement. So the important thing is to have a very, very steady tenant that's not going to go anywhere. So we do a lot of due diligence on those tenants, make sure that they're, you know, the seller slash tenants, that the company is very, very solid, and then we do the deal.
So, okay, so I've got a bunch of follow-up questions. I'm just going to shoot them out there and hopefully we get
Yeah.
So how big is a deal like this usually? And so how many investors are you looking for and how often do you do these?
Yeah. So they will vary. I mean, we've done syndications where we've raised as little as 500,000 and as high as 8 million, I think was our largest raise so far. And so it'll depend on the raise, right? So a fairly typical minimum investment is 50,000. And so, you know, you can do the math. We have had some where there was 100,000 minimum, and we've had a couple where it was a 25,000 minimum, but generally 50,000 is a fairly typical minimum.
That was amazing. So much information. But really, really good stuff. Yeah. Thank you, Monique. I think that was super, super helpful.
It was my pleasure.
Yeah. And, you know, if you had one tip to give my ladies about investing in syndication, what would you say?
I would say if you want to do this, then you need to get on the list of people who do syndications, right? So connect with people, find out, you know, get a set. I mean, we have our women's intuition, right? So like tap into that as well as your, you know, learning, and you just find people that you think you could, you know, get to know them, like who you can like and trust, and that can do a good job with syndication. So because that you're not going to have, if you're passively investing, that's the only way you're going to get access, really, is to get into relationship with people who have these types of deals. And then when you do, and this is part of the conversation I have when people apply to get into the investor club, we can hop on the phone and I get clarity on their why. Why do they want to do this? Because depending on their why, different investments will be a better fit for them or not. So it's important to tap into your why. It's important to know what your resources is, what you can invest, you know, where your funds are, and, you know, just have that clarity about, like, you know, where your money is and when you need it, right? So if it's money that you're going to need in a year or two, right? So if you're 65, so that was the example, and you want your money in 2 years, a deal where your money is going to be locked up for 5 years, probably not a best fit for you, right? If you're going to need it like that quickly, I mean, there will be but if you're okay with just like the cash flow or something happens, then you know, then that's fine. But if it's, because like I said, it could be 5 years, but it could be 7, depending on what, you know, what's going on. It could be less, but it could be more. So you just need to get a sense of when you're going to need the principal back, and make sure that it all makes sense for you. But those are the conversations that we would have, that conversation on our call, so I could get clarity on and make sure that you're getting into deals that make sense for you.
Got it. So on the screen, you've got how to contact you. But for those that are listening, why don't you tell everybody how they can get in touch with you?
So to join the investor club and get into a one-on-one passive investing strategy session with me, then go, ladies, I'm going to send you by gender to 2 different places. So ladies, go to reigoddesses.com. Gents, if you're listening, and go to vip-assets.com. They'll both get you to the same place. But reigoddesses.com is, when you go on there, you'll understand. It's speaking to women. It's a lot of pink.
Exactly.
Let me just say that.
That's awesome. Well, that was so helpful. Monick, thank you for coming back to the show and sharing all this information with us. So valuable, as always.
It was my pleasure. Thank you so much for having me.
And ladies, thank you for joining Monick and I for this conversation. I hope it was really helpful. I know we did a little bit of a different format, but I hope you got a lot of great information. Definitely contact Monick if this is a strategy that you're interested in. And I look forward to seeing you next week. So until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you soon. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.